This is Nightly Business Report with Tyler Matheson and Susie Garrett. Brought to you by...
Sailing through the heart of historic cities and landscapes on a river, you get close to iconic landmarks, to local life, to cultural treasures. Viking River Cruises, exploring the world in comfort.
Crude concerns. Oil prices rise to their highest levels in more than 2 years. But if tensions with Syria continue to escalate, could a spike in gasoline prices be next?
New mortgage rules. They're designed to take risk out of the market. But what could they mean for investors and home buyers and the pace of housing recovery?
And slashing college costs. Even as tuition skyrockets, there's a way for students to get credits at cut-rate prices. Tonight, we kick off the first of a three-part series on new ways to pay for college. We have all that and more tonight on Nightly Business Report for Wednesday, August 28th.
Good evening, everybody. I'm Bill Griffith in for Tyler tonight, along, of course, with Susie Garrett. On Wall Street, just like about everywhere else, it's a waiting game. Waiting for confirmation that the U.S. and its allies are nearing a decision on staging a military strike against Syria. That fear, of course, sent the markets into a tailspin on Tuesday. Today, a different story, though. Stocks ended higher. That after traders heard no further saber rattling about Syria and after a surge in oil prices that actually helped lift energy stocks today. The Dow ended higher after 3 straight losing sessions. It finished up 48 points. The Nasdaq was up 14. The S&P added 4. Crude oil up another $1.09 a barrel, closing at a more than 2-month high now. It's first settled above $110 a barrel since May of 2011, and that helped the entire energy sector, and it sent shares of Dow components ExxonMobil and Chevron each up more than 2%.
Now, even though oil prices spiked higher on concerns about Syria, prices at the pump here at home are holding steady so far this week. But that could change. Hampton Pearson explains.
As millions of Americans get ready to hit the road for the long Labor Day holiday weekend, gasoline prices at $3.55 a gallon on average nationwide are down about 8 cents a gallon from a month ago. But oil industry analysts say possible military strikes against Syria could be a game changer, with some predicting a 10 cents a gallon spike in prices at the pump in early September.
It's very likely, if there is a military attack in Syria, that we'll see the highest prices we've seen since 2008.
In the summer of 2008, crude oil topped $147 a barrel and gasoline prices went over $4 a gallon. By October, both figures had been cut in half. What's different this time is that oil prices began rising before the standoff in Syria, back in July, when tensions in Egypt began raising concerns about supply disruptions through the Suez Canal.
What I think we're going to have is the fear of supply interruption, which is going to get the futures to rally. And what it might also do is prevent ships from being insured. Can't have the ships insured. Now all of a sudden, you can't have the shipment of crude oil across like the Suez Canal.
But unless and until there are attacks and reactions, figuring out the price of crude oil or gas at the pump will keep market watchers on edge.
I think you want to position for a big pullback here because the economy in the U.S. seems to be slowing. Some of the production issues should resolve themselves later in the year. There's a great argument for the price coming back down, I think, as rapidly as it may go up here.
For Nightly Business Report, I'm Hampton Pearson in Washington.
Now, aside from the tension in the Middle East, U.S. markets are, of course, fixated on when the Federal Reserve will begin to pull back on its bond buying program, or as Wall Street has become fond of calling it, taper. But other markets and economies around the world are also keeping a close eye on the Fed. So let's take a quick trip around the globe, namely China, India, and Brazil, to see how they might be affected.
Here in China, people feel that this country would be relatively immune if the U.S. Federal Reserve scaled back its easy money policies. China has capital controls, so the money that would be flowing out of the emerging markets to the United States would mainly be coming from other Asian nations. But that doesn't mean that China is totally out of the woods. Analysts say that the outflow of capital from this part of the world could hurt the economies out here, which would in turn depress global demand and China's economy. For Nightly Business Report, I'm Eunice Yoon in China.
Here in India, there's been quite a bit of panic since the Fed hinted that it would look at calibrated tapering of the stimulus program. Rupee has depreciated more than 17%. Stock markets dropped more than 10% and borrowing rates have jumped to levels last seen during the Lehman crisis. A lot of pressure is coming from the FIIs, which have withdrawn over $12 billion since the Fed announcement. But tapering is not the only worry. India's parliament remains deadlocked on crucial economic issues. Current account deficit is widening, growth is down, and inflationary pressures remain high. Money managers are reading the measures taken by the RBI and the government to prop up the rupee as a panic move. And that's just adding to the pressure. For Nightly Business Report, I'm Gopika Gopakumar in Mumbai.
Here in Brazil, bets on Fed tapering has led to capital flight that's seen our currency weaken by around 20% against the dollar so far this year. Aggressive rate rises by the central bank has done little to stem the weaknesses and actually threatens to fuel already high inflation. The government is trying to appease nervous investors, saying it has several weapons to fight FX volatility. But you have to remember, presidential elections are just around the corner, over 13 months away. And as the recent civil unrest proved, people here take the reals in their pocket very seriously. So let's hope next year's Soccer World Cup and 2016 Olympics can brighten the mood in Latin America's largest economy. For Nightly Business Report, I'm Carolina Cimenti in Rio de Janeiro.
Now, some of those same countries are also straddled with debt and political uncertainty. And for American companies that have exposure to those markets, the risk is big. Seema Modi reports on what it could mean for your money.
Emerging markets, once considered the saviors of the world economy, thriving even in the face of the U.S. and Europe's recessions. But now the BRIC nations are threatened by debt, inflation, and political uncertainty. And those risks could hit the bottom line of some of the biggest companies in the U.S. It's a double whammy for the multinationals. The rapid depreciation in emerging market currencies this week makes their products and services less competitive. And it also means their profits, made in local currencies, are worth less in dollar terms. So which U.S. companies could get hit? Agricultural names like Mosaic and Monsanto have exposure to Brazil, a country dealing with political uncertainty. PepsiCo and Alcoa generate sales in Russia, which has seen its growth rate slow. In India, a country dealing with rising inflation, American Tower and Peabody Energy do a great deal of business. And lastly, China. Companies like Advanced Micro Devices and Yum Brands all generate more than 50% of annual revenues there. According to Thomson Reuters, these basket of stocks that have exposure to emerging markets are underperforming the S&P 500 on a 3-month basis. However, JP Morgan's Richard Madigan says that multinationals with exposure to BRICS could be a huge buying opportunity.
If you watch currencies fall 10, 15, 20%, if you were looking at strategic investment that you were planning to build up manufacturing domestically over the next 2 to 3 years, you're actually going to increase that investment today because you just got a haircut of 20% on that investment.
While investors battle over the fate of emerging market stocks, there's one thing they do agree on. Further volatility in these markets will continue as these countries assess what type of structural reform is needed to solve their problems. For Nightly Business Report, I'm Seema Modi in New York.
Joining us now to talk about how investors can navigate through all of these uncertainties, from Syria to oil to emerging markets, Jeff Kleintop with us tonight, Chief Market Strategist at LPL Financial. Jeff, good to see you again.
Thanks for having me on.
We've built quite a wall of worry for investors to think about right now. Should they be concerned? I mean, we're going into the fall. We didn't even get to the tapering. We got the possibility of a debt ceiling crisis as well. Should investors be concerned?
Well, I think it's understandable why they might be feeling uncommitted here, with the Fed committed to tapering and the U.S. committed to military action in Syria and the Congress committed to fighting over the debt ceiling. All those issues have left investors on the sidelines. Listen, it's taken a long time for individual investors just to get back to even after the losses of 5 years ago, and it's understandable they may be a bit cautious here. We don't see a major pullback here of 10 or 20%, maybe another one of these 5 or 10% moves, which maybe we're halfway through already. But investors who want a hedge in their portfolio, who aren't willing to ride through this volatility, may look to gold, may look to oil as effective hedges in their portfolio. They tend to go up when geopolitical risk rises. But you've got to be quick in getting back out again, because once decisive U.S. military action takes place, they quickly reverse course.
But Jeff, getting back to some of the political risks here, talk us through what the market reaction would be if there is any military action, if it's prolonged, or if there's some kind of diplomatic resolution. What can investors expect in those scenarios?
Sure. It's interesting. It seems to be, now that we're committed to some military action, the faster it gets over with, a decisive strike seems to be the best reaction for the markets, at least looking back historically. Sometimes the markets don't react. In 99 in Serbia, in 95 in Bosnia, it didn't really affect the markets. But if you look back to other events, the Gulf War is a great example. From when we pre-committed to action in August of 1990 to where we actually took action in January of 1991, stocks fell. Once action was taken, stocks rose. So I think if we take action and it's decisive, stocks will begin to turn around on that. It's that lag between when we pre-committed and do it that's the drag. I think today's lift in the stock market tied to maybe Defense Secretary Chuck Hagel's comments that it might just be days away rather than weeks away. But if there's some other diplomatic solution, that could be a positive as well. But again, it needs to be decisive and clear cut, or this will linger over the markets, along with all those other issues we talked about, the debt ceiling and the tapering.
Right. Now, that's the stock market. What about interest rates and the Treasury market? As we know, as the markets anticipate tapering, yields have been going up. But when they fear this military action against Syria, yields go down. So which way do you think they're going here in the near term?
But they didn't come back much. That's what's interesting. They came back a little bit, but I think they are headed higher. I think even in the face of this military intervention, which may not be that decisive, it may take place over the course of several weeks. I still think yields are probably headed higher, though not dramatically so, simply because it's the economy that matters here. It's domestic concerns, not foreign ones, that cause the stock market pullback and I think are affecting the bond market
Jeff,
as well.
real quick question because we have to go now. What about cash? Is it wise to put some money into cash now, sell out some stocks?
I don't think so. Cash is still earning a negative real return. I think investors here need to stay committed to their long-term asset allocation.
Jeff Kleintop of LPL Financial. Good to see you again. Thanks for joining us tonight.
Great to see you.
Still ahead, what do the New York Times, Twitter, and Huffington Post have in common? All of their websites have been victims of hack attacks. How well prepared are businesses to prevent future ones? That's coming up. But first, how the international markets closed today.
Some news tonight about housing now. We had pending home sales. Those are the signed contracts to buy a house that have yet to be closed. That fell by 1.3% in July, but that's coming off a more than 6-year high in June. A realtors group says that the recent rise in mortgage rates, now averaging around 4.6% for a 30-year loan, may be keeping some would-be home buyers on the sidelines. Meantime, a bankers group reports that applications for new mortgages fell again this past week, with a sizable drop in refis.
Speaking of mortgages, some new rules out today aimed at cutting risks in the mortgage market. The FDIC, this is the federal agency that insures bank deposits, approved new rules that require mortgage lenders to keep a stake in the loans that are bundled up and sold as securities. Diana Olick joins us now from Washington. Diana, more rules. We keep getting them from Washington. Tell us a little bit about the details of these proposed new rules.
Well, I just want to clarify that these are proposed new rules and they haven't passed anything. They're still putting them out for comment. This is actually the second go-around that federal banking regulators have done with these rules. They're about a qualified residential mortgage. That is, which mortgages from the banks would be exempt from risk retention under Dodd-Frank. And what they've done is they've actually loosened up a little bit. Their first proposal 2 years ago said that these mortgages had to have 20% down. Now they're saying they're going to take that out. They've heard from the banking industry. The banking industry did not like that. Now they are aligning their proposed rules with those from the CFPB that have already been put into place earlier this year. So when we say new rules, they're actually kind of copies of rules already in place.
What do they mean for investors and, oh, by the way, home buyers as well?
Well, look, the new rules that have been going into place, which a lot of the banks are already using, are going to make it more safe for investors and for homeowners because they're going to take a lot of risk out of the markets. You're not going to be able to have the type of negative amortization loans, the interest-only loans that were really a big part of the housing crash, that these were loans that were very poorly underwritten and that went bad quickly and caused the housing crash. So it will be tighter. Things are already tighter, as we know. What they will do is just clarify the risk retention for banks, which will make things, easier for them to understand in this whole new realm of rules. It will also safeguard borrowers, even if it does make it a little bit harder to get the loan.
So, Diana, is this going to be good or bad for the housing recovery?
Well, it depends on who you ask. I mean, there are people out there who say there are too many rules. There's rules upon rules. And what we need now is to loosen up credit a bit to get more home buyers back into the market. Then you say, well, wait a minute. There are others out there who just want these safeguards in place, want to know that the mortgage market is going to be a place that will not crash the way it did 5 years ago, and that we won't see the kind of mortgage abuses that we saw back then. So, again, it's kind of a double-edged sword. We need the rules to protect consumers, but the rules also will make it, stricter to get a mortgage.
Diana Olick, thank you. Sure. See you later. Elsewhere, Zale posts its first full-year profit since 2008, and that's where we begin tonight's market focus. Strong sales were driven by the addition of exclusive jewelry lines that offer high margins. For the quarter, Zales beat earnings and revenue expectations and plans to close more unprofitable stores. And the stock soared almost 30% on that news. It closed today at $11.63. Shoppers were also spending at Express. The apparel and accessories retailer topped analyst sales estimates for the third quarter in a row and boosted its profit forecast for the second time this year. The CEO says that its customers are responding enthusiastically to its selection of merchandise right now, and the stock climbed as a result more than 6% to $21.10.
But at Chico's, this is the women's apparel retailer, says that sales and profits are down. The company blamed it on lower traffic, fewer transactions, and less money spent per purchase. But investors brushed that off after the CEO said much of its inventory had been cleared out and suggested that sales in the current quarter are improving. That was enough to send the stock up 4% to $15.95. Williams-Sonoma was scheduled to release its earnings after the bell today, but did so about an hour before the close. The retailer posted earnings higher than analyst estimates, but its profit outlook fell short and gross margins dropped. So that pressured the stock, and it lost 4% to $56.97. And a good day for shareholders of Avago Technologies. The wireless chip maker beat street earnings and revenue estimates and is forecasting better than expected growth for the current quarter. It's getting a boost as some of the world's biggest smartphone makers launch new products. Avago chips are used in Apple iPhones as well as devices made by Samsung. The stock rose almost 5% to $38 and change.
A new warning out today about just how vulnerable your cell phone might be to computer viruses. A new study by the FBI and the Department of Homeland Security says that smartphones using Google's Android operating system are the primary targets now for malware attacks. Android devices received a staggering 79% of all malware threats to mobile devices last year, with text messages hiding about half of all the malicious software out there.
Following some high-profile hackings this week at the New York Times, Twitter, and the Huffington Post, a lot of companies are evaluating just how safe their websites are and how prepared they are against an attack. And Eamon Javers joins us now with more on what companies and security experts are doing to protect against future intrusions. Eamon, nice to have you here.
Thanks for having me.
What are they doing?
Well, they're not doing enough if you talk to cybersecurity experts. Now, of course, cybersecurity experts have a vested interest in telling companies to buy more cybersecurity software. Right. But what we saw this week with the New York Times was an attack that the Times said, in particular, was done by the Syrian Electronic Army, or somebody who was trying to appear like the Syrian Electronic Army. Now, that's a group that's loosely affiliated with the Syrian regime, Bashar al-Assad, that's been under such scrutiny over the past coming days in the possible subject of a U.S. military strike, which raises a whole geopolitical question here for companies and institutions that are trying to defend against cyber attacks. Will they sort of reap some of the blowback of U.S. foreign policy decisions as hackers respond to things that the United States is doing by targeting American companies? That's something that's a little bit new, that we haven't really seen that before.
Right. This has to hit them in the pocketbook, though. What kind of losses are we talking about when you see these kinds of attacks on companies like the New York Times?
Well, so far, so good. I mean, the New York Times site was down yesterday for certain people who were trying to access it, not necessarily for everybody. They told me they were able to get it up pretty quickly. So the revenues lost by the New York Times yesterday, probably not significant. What the problem will be is if the hackers are able to get beyond just the public-facing websites and get into the guts of some of these companies and get credit card information, get into the material operations of these companies, that's where you could see significant losses.
I mean, the other issue on the side of the businesses, I mean, these are high-profile companies that put out the news that they were hacked, but a lot of companies still think it's a taboo to say that they've been vulnerable and that they've been hacked. I mean, how much is that holding back from them solving their problems?
It's one of the biggest problems that cybersecurity experts face, is that the companies who are their clients, they're working with these companies to try to prevent these attacks. They don't want any details getting out there, partly for liability reasons, because there's money at stake here on some of these disputes over who's responsible for this, partly for brand protection reasons. They don't want to be embarrassed by this. The experts say they would like these companies to be more forthcoming, to really come clean and tell people, tell Americans, tell customers when they've been hacked, because that will show the scale of the problem and the types of people who are doing it and some of the things that they can do to start to solve it.
I suspect we'll be talking more about this in the future, unfortunately.
Absolutely.
Thanks, Eamon.
Thank you.
Eamon Javers joining us tonight. Coming up, as tuition rates rise, some schools are letting students get credits at deep discounts now. The story when we kick off the first of our three-part series on new ways to pay for college. But first, how commodities, treasuries, and currencies perform today.
JP Morgan Chase is facing more heavy fines from federal authorities. The nation's largest bank may have to pay as much as $600 million in penalties as part of a global settlement with U.S. and British regulators over those huge trading losses last year in the so-called London whale scandal. Also today, word that the government's Consumer Financial Protection Bureau is expected to fine the bank $80 million for selling a credit card identity theft protection service that didn't deliver on promises to customers.
Well, another big fine, this one against a huge casino operator, Las Vegas Sands, now agreeing to pay more than $47 million to settle a federal investigation after it failed to stop money laundering when a gambler with known links to drug trafficking made millions in money transfers through its gambling operations.
Colleges everywhere are back in session this week, and tonight, a nightly business report kicks off a series looking at new and creative ways that people are paying for school and making that college education really pay off. In the first of three reports this week, Mary Thompson tells us how some schools are letting students get credits at cut-rate prices.
There is no MOOC U, but MOOCs, or massively open online courses, are a small but growing presence on some college campuses, like San Jose State University. Here's Professor Ron Rogers.
Being able to teach effectively to larger numbers of students online is the key, I think, to both holding the cost down and increasing access for students.
Partnering with online platform provider Udacity, San Jose State professors designed 5 courses for an ongoing pilot program. Teaching courses online opens them up to hundreds, if not thousands, of more students at more flexible times and at a lower cost, a cost that's still needed to cover fees for transferring MOOC credits and to pay for professors who grade papers and test students to make sure coursework is completed. The savings can be substantial. Incoming San Jose freshman Harriet Kansimi took a MOOC to fulfill a math requirement. The $150 she spent, $1,550 less than the cost of a campus class. And she saved on gas money.
First of all, the cost of having to travel to San Jose like every day, that saved me a lot. And also, I was able to study on my own pace.
The cost savings important, given a year at a private four-year college costs upwards of $39,000, a public college over $17,000. Other schools folding MOOCs into their programs, Antioch University and the State University of New York, which estimates MOOCs could cut the cost of a degree by a third. And while educators downplay MOOCs replacing all classes, believing MOOCs work better for courses in engineering, science, and math, as college costs continue to rise, mixing a MOOC in with a traditional curriculum could cut the cost of college by degrees. For Nightly Business Report, I'm Mary Thompson.
And tomorrow we continue our series on new ways to pay for college with a look at how some students are turning to crowdfunding to finance the high cost of tuition.
Finally, tonight we commemorate the 50th anniversary of the Reverend Dr. Martin Luther King Jr.'s I Have a Dream speech in Washington, D.C. Tens of thousands of people, including marchers who were there for the original speech, civil rights leaders, politicians, ordinary Americans, all took to the National Mall today to remember the words of Dr. King, noting how far the nation has come toward equality for all and how far we still have to go. President Obama spoke today from the very same spot where Dr. King spoke those unforgettable words on the struggle for civil rights half a century ago.
But we would dishonor those heroes as well, to suggest that the work of this nation is somehow complete. The arc of the moral universe may bend towards justice, but it doesn't bend on its own. To secure the gains this country has made requires constant vigilance.
A poignant moment, obviously, and I cannot believe it's been 50 years since that speech, 1963.
I was reading the speech today. It gives you chills.
It does.
Really an
Great stuff.
amazing speech. That's Nightly Business Report for tonight. I'm Susie Garib. Thanks so much for watching.
I'm Bill Griffith. Have a great evening. We'll see you again tomorrow.
Nightly Business Report has been brought to you by
Sailing through the heart of historic cities and landscapes on a river, you get close to iconic landmarks, to local life, to cultural treasures. Viking River Cruises, exploring the world in comfort.
I'm Susie Garib with a Nightly Business Report news brief. On Wall Street, stocks ended higher today despite the increased likelihood of a U.S.-led military attack on Syria. The Dow rose 48 points, the Nasdaq up 14, and the S&P added 4 points. A surge in oil prices gave a big boost to stocks. Crude oil prices settled above $110 for the first time in 2 years. That sent shares of Dow Components, ExxonMobil, and Chevron up by more than 2%. Zale dazzled investors. The jeweler's stock shot up 30% after recording its first profitable fiscal year since 2008. Pending home sales declined more than 1% in July. And Nintendo is slashing the price of its Wii U gaming console. It's bracing for an all-new game systems from rivals Microsoft and Sony. Be sure to tune into Nightly Business Report right here on your public television station.